Let's take a look at how transactions relating to inventory are reported in the financial statements. Your balance sheet, the partial balance sheet is shown here, will have your ending inventory balance at the end of your accounting period. It's a current asset and it's less liquid than accounts receivable or cash, but more liquid than prepaid expenses, so it's typically shown right after accounts receivable. Your cost of goods sold, which represents the cost of the inventory that has been sold, is shown in your income statement. Cost of goods sold is an expense, and it's shown in your income statement right under sales. Along with cost of goods sold, companies do report the gross profit. So typically, if a company has inventory, you will see sales, and you will see cost of goods sold right after sales. Some companies report gross profits, others don't, but if you see cost of goods sold, you know that that particular company has inventory. Now the next question is, how do we determine the numbers that we would put in our financial statements? In other words, how do we value our ending inventory and our cost of goods sold? The number of physical units in our ending inventory is determined by a physical count at the year end, but we're talking about a dollar amount. How do we report the dollar amount? How do we figure out that if we have 10,000 items in our inventory, what is the value of that 10,000 items? And that's what we're going to talk about next. Companies use 4 inventory costing methods to value their ending inventory and cost of goods sold. The 4 methods are specific unit cost, average cost, first in, first out, and last in, first out. Specific unit cost is only used by very few companies. Typically, it's used by businesses that have unique inventory items. Typically, automobile companies, antique furniture, jewelry, real estate, those kind of companies. Under specific unit cost, businesses cost their inventories at the price of the particular unit. So each unit of inventory will have a different cost. This is typically too expensive for inventories with common characteristics, like if you were pricing textbooks or if you were pricing cereal, specific unit cost is too expensive. So companies use different methods to value those inventory. But let's take an example of a jeweler. If a jeweler buys a necklace that is worth $50,000, that necklace will have a specific cost, which would be $50,000. Let's say he buys a pair of earrings for $10,000. Those earrings will have a specific cost of $10,000, bringing a total of $60,000 inventory. Now, if the jeweler sold the pair of earrings, the cost of goods sold would be the $10,000, the specific cost of those earrings. The ending inventory would consist of the necklace, which would be $50,000. Again, this method is too expensive for inventories with common characteristics, and most companies use one of the other 3 methods that we're going to talk about next. We're going to take a look at a company that has 5 units of beginning inventory. The 5 units are represented by these 5 boxes, and those 5 units have a cost of $5 each. So the balance in the beginning inventory is $25. Next, we're going to take a look at the inventory transactions this company had during our accounting period, which is the month of January. On January 12th, this company bought an additional 7 units at a cost of $6 each, which comes up to a total of $42. On the 20th, they bought 6 units at a cost of $6.50 each, which comes up to a total cost of $39. So remember, purchases increase inventory, and I'm only showing you one side of your journal entry. Each transaction has a journal entry that has a debit to our inventory, and the credit will be either cash or accounts payable depending on how they pay for it. But I'm just going to show you the debit side of the transaction. So for the transaction on the 12th, we debited $42 for the 7 units of inventory we purchased, and for the 20th, we debited $39 for the 6 units of inventory we purchased. And then on the 26th of January, they bought another 3 units, this time paying $7 each for a total of $21. Now, the company has bought several items with different prices, different per unit prices. So we need to value how much is our cost of goods sold and how much is our ending inventory. That is the dilemma here. The first thing we need to do is figure out how many units we had available for sale. Available for sale includes your beginning balance of 5 items and then subsequent purchases during the month. So if you add all of them up, if you add up all those little boxes there are 21 items which we say were available for sale during the month of January. Next, I'm going to tell you that we sold 17 of those items, which means we have 4 items left in our ending inventory. How did we get 4? We had 21 items available for sale. We sold 17 of them, so you subtract 17 from 21 and you get 4 items left in your ending inventory. Now the next question is, how much was our cost of goods sold and how much was our ending inventory? If we had purchased all those items at the same price, we would easily be able to calculate our cost of goods sold and our ending inventory. Let's say every item was at $5. We know that those 17 items we sold would have cost us $5, and our ending inventory, each item would have cost us $5. But here we have different purchase prices for each purchase, and this is typical of day-to-day life. We do not get the same price. Prices vary in the marketplace, and therefore we would pay different prices for different purchases. So how do companies figure out how much is the cost of goods sold and how much is their ending balance? Companies use those 3 different inventory costing methods to come up with their value of their ending inventory and the value of cost of goods sold. The 3 methods are average cost, first in first out, and last in first out. You will see weighted average being used, and I will sometimes call it weighted average. That is the same as just average cost. Sometimes your book calls it weighted average cost, and sometimes you will see it simplified as average cost.